Hello, everyone. Welcome to Smartkarma's Webinar Wednesday. I'm Michael Tegos. Today, I'm excited to welcome Mitchell Kim to discuss Pinduoduo, one of China's e-commerce giants. The company has made waves recently, surpassing Alibaba in annual active users. But there are reasons for investors to be nervous about it, and Mitchell will tell us more about that in just a second. Mitchell is a fundamental equity research analyst with 20 plus years of experience. He has a reputation for rigorous analysis, focusing on stock price drivers and providing differentiated or contrarian ideas. Just before we start, a few seconds to take care of our standard housekeeping. You're very welcome to send in questions throughout the webinar for Mitchell using the Q&A button on your screen. And please do not pre-share this webinar without express permission. Our recording, as always, will be available on the page that you use to register. Mitchell, let me welcome you to the webinar. Thank you very much for being with us today. Over to you.
Okay, thank you, Michael. And thanks everyone for joining this morning's webinar. And I know that some of you may be an investor and holder of PDD, and all the more reason why I'm grateful for this opportunity to share my views on the stock. I have been, closely following the stock from the get-go when the company went public in 2018. In fact, I was telling Michael that I was the first analyst to do a live interview with CNBC Asia on Pinduoduo on the day or day after it went public. So it's a very interesting stock, and I'm happy to talk about it today. As my title, hopefully you guys could, all of you could see my screen, and that my title is Pinduoduo, Know When to Run. It's one of my favorite titles. Obviously, I stole that from Kenny Rogers' album, The Gambler. Know when to walk, know when to run, know when to fall, know when to walk, know when to run away. And so that's the title that I stole. And I'm using that because there are 5 key reasons why I'm nervous about Pinduoduo. And if I am speaking to Pinduoduo holders, I would certainly think that some of those investors should be sweating a bit about what to do with the stock. So let's go. Okay. All right. So let me first say that Pinduoduo is the best performer since the stock went public in August 2018. It's outperformed Alibaba, JD, and VIP, even though some of those JD and VIP has also performed very well. But one thing that does catch my eyes is that a lot of the performance came in after November of 2020. So let's visit that. Let's visit that factor and talk about 5 reasons why I am cautious on the stock. Well, as I said, the first point is that if you look at the share outperformance, much of that came in November 2020. And why did that happen? And second reason is that I'm going to touch on valuations. Pinduoduo is trading at a significant premium to its peers. Is that justified? And third, what happens to a stock when they are ultra growth stock, and then but no one could stay at ultra growth forever. And then what happens to the stock when the growth dips below 100%? Because Pinduoduo is not the only stock that's ever done that. JD has done that. VIP has done that. Fourth reason is that customer growth, or the annual user numbers, the user growth is slowing, even though Pinduoduo has surpassed Alibaba. And Alibaba, once it hit 700, its growth had slowed quite a bit as well. So given that, where does growth come from? And lastly, I am concerned about the path to profitability. I always argued, whether it was JD or even VIP, where does profit matter? And I argue that profit does matter. And so let's visit all those 5 reasons why investors should be nervous. As I said before, much of the outperformance, I wouldn't say all of it, but certainly a good portion of it has occurred post November 2020. There are 2 factors that really drove that, in my mind, and that is, one is that on November 10th, the anti-monopoly law was announced again, and largely targeting on Alibaba. So I think the market assumed that if Alibaba is targeted, who is the beneficiary? And I think the natural response to a natural answer is Pinduoduo, because Pinduoduo is the one that looks most like Alibaba in that it is a almost pure marketplace platform, whereas JD is still more direct sales dominated platform, and VIP is much more of a niche. Second factor is that Pinduoduo did show a very strong re-acceleration of its top line growth when they reported their third quarter on November 13th. So combination of those 2 factors really started pushing adding momentum to the stock. But let's think about the AML risk, the anti-monopoly law risk. One of the things that I think the government will look at, if that is the case, is whether a platform like Alibaba, do they have a exclusivity on merchant? That is, can a merchant sell their products and services on Alibaba and another competing platform? And and we all know that Alibaba has certain restrictive measures, and so merchants are afraid to really list on other platforms as well. So we know that does go on, but the government hasn't come out with anything strictly that measures that enforces that yet. But the other thing is, there's another talk about whether government will be or government will be looking at subsidies, marketing subsidies. But if you actually look at marketing subsidies, Pinduoduo is actually the one that really faces the most risk, because it utilizes, it leverages a lot, marketing dollars to generate revenue. In fact, Pinduoduo's marketing costs make up almost 70%. It used to be even higher, but it has come down because of the scale. And it's not now at like 60 to 70% of revenue. But even then, if you actually look at it, if you compare that, and how do I compare that? I compare by looking at the per marketing dollars, how much does a company generate in terms of revenue dollars? And if you actually look at how much revenue per marketing dollars, Pinduoduo is really at the bottom, which means that they're subsidizing a lot to generate less. So given that, in fact, if the government does come out with that restrictive measures, then Pinduoduo is certainly not immune to it and may even be at a greater risk. So I think that, so if the market believes that Pinduoduo is a beneficiary, I would say that may not be true. A second factor that I'm concerned about is that Pinduoduo is expensive. This is kind of tricky to say because it's very difficult to value this stock because it doesn't generate profits. And the only thing you could really look at is that it's like, metrics like buyer growth or annual user growth, that is, or revenue growth, GMV growth. But this was similar to JD. JD in 2015, it still was not generating profits. So a lot of my clients were asking me, how do you value this stock? And really, what you resort to is pretty much price to sales or EV to sales, or in some cases, I think you could make an argument for EV to gross profit. But Pinduoduo is not really JD because it doesn't really have direct sales. It's a platform. So talking about its gross margin, gross profit doesn't really make sense. So naturally what we got left to do is really look at its price to sales. And if you look at price to sales, Pinduoduo is expensive. Now, it's currently trading at around 17 times. Now, this is based on quarterly revenue. So obviously, if you want to compare this to other more global firms, you would have to divide this by 4. So we're looking at around 4.2 times its annual revenues. And then this is on our quarterly revenues. That is expensive. It's expensive by any measure, especially if you compare that with JD or even with Alibaba. And you could say that, hey, Pinduoduo is ultra growth, therefore it should command a premium. But if you actually look at how JD was trading in terms of price to sales back when in 2014-15, it never really traded this expensive. So I think that there's certainly a significant premium for PDD. And let me show you what JD looked like back in 2015. So if you look at price to sales comparison for JD.com, and that circled unit right there is from 2014 to 2015. And the orange bar represents the price to sales, and the blue is the share price. And if you look at price to sales, even on a quarterly basis, it really didn't go much beyond like 8 times, which means on an annual basis about 2 times. But if you look at currently it's trading at around about 4 times on a quarterly revenues and latest quarter. But on an annual basis is only about 1 time. So JD.com is much cheaper on a price to sales basis. And of course, that may not be fair because obviously JD.com is a 90% direct sales and only 10% of its revenues are coming from marketplace. So again, a comparison does become difficult. But if you want to just say, hey, if I'm gonna value a growth stock, I'm going to look at price to sales. Well, if you do, you're going to realize it's about 4 times as more expensive than somebody like JD. How about against a platform player like Alibaba? Well, Alibaba, yes, it did trade at a much higher multiple back when in 2014, but one thing you got to keep in mind is that Alibaba is generating operating margin at that time almost 30 to 40% operating margin. So it's a high margin business because it's a pure platform company. But even back then, it was trading at more like around 15 to 20 times on a quarterly basis. So only about like 3 to 4 times on an annual sales basis. So I think that to say that to say that Pinduoduo is an ultra growth stock and therefore it should trade at much higher price of sales really doesn't cut it in my view, because I do have more of a historical perspective. Now, number 3, revenue growth. When in my experience, the revenue growth, once it breaks through the floor of 100%, the revenue growth as a share price driver becomes less correlated, and reason why I say that, if I look at VIP shop, if I look at JD and even Alibaba, that I feel that the revenue growth doesn't stops becoming a strong share price driver. So you could see in this graph chart here, I have superimposed the Pinduoduo's last 4 years from 2018, 19, 20, and what my estimate for 2021, and onto the first 4 years of the 3 incumbent players. And I do see a very similar trend. And if that is the case, we should definitely look at how the revenue growth really impact a share price for some of those stocks, certainly. But if you actually look at it, right, JD.com's revenue growth was around 100% up to, or even more than that, but in 2012, it was at 100%. Basically, revenues doubled. But 2013, it started to drop, and in 2014 and 15, it was right at around 70 to 60%. And after that, it decelerates much faster. If you look at VIP Shop, and in fact, its growth was 200% in 2012, but once it fell below 100% in 2015, then the deceleration was much more rapid. In fact, it fell below 50% the following year. So let's keep in mind that Pinduoduo's top line growth did dip below 100% in 2020, although because the Pinduoduo had a direct merchandise sales in the fourth quarter, that it actually looks like revenue growth is around 100%, 97%. But if you strip that out, it's actually 80%. So it is going from much higher 250 to more like 80%. So from my perspective, I am beginning to see Pinduoduo following this very similar growth trend. Obviously, no company is going to be able to sustain 100% growth every year. But what I'm looking for is how has that impacted share price in the past? So if you look at JD.com in 2014 and 15, if you look at it, the company was still generating 73, 60, then 70 to 50% revenue growth, yet it didn't do much for its stock price. In fact, that's when I probably had the only sell rating on JD.com at that time, and the stock price was trading between $30 to $20 range. And in fact, it hit $20, close to $20, like 3 times that year in 2016. And even though the company was delivering on 50 to 60% revenue growth. So just because you have 50 to 60, 70 type of revenue growth, that doesn't mean that stock price will continue to maintain support and have momentum to grow. Similarly, if you look at VIP Shop here, from like peak, if you look at its revenue growth from 2013 onwards, it continued to fall. And if you look at the share price back then, the peak was at around $30 in April, around April 2015, and after that, the bottom, bottom kind of fell out because the company just was not able to maintain its revenue growth, and revenue growth fell sharply. But at the same time, so the stock didn't really recover until about 2017, end of 2017 and 18, until when the market got wind of that, Tencent and JD.com decided to invest in VIP Shop. So point again is that just because you were high ultra revenue growth stock and you fall into 70, 60, 50% range, don't expect that kind of momentum to continue. That's based on historical lessons, I think. In fact, so where's Pinduoduo now? Pinduoduo, if you look at it, the last 4 years, and if you look at this chart, you can see that. Let's skip over FY17. That's 3,500. That's crazy growth. Obviously, coming from a very low, small denominator. It did grow very rapidly, but it also decelerated very quickly as well. So in 2019, it grew still more than double, 130% revenue-wise. But in FY20, again, if you normalize it, it only grew 80%. So I think I am I do forecast about 48% growth in 2021. And obviously, in order for Pinduoduo to maintain that kind of growth, you need to have you need to have double barrel shotgun. That is, you need to have a strong user growth, and you also need annual spending per buyer to continue to grow at some 30% range. I think that's not easy to do. So that's something that I would be focusing on. Number four reason why I'm taking a cautious view is that and customer growth, that is the annual buyer number, is slowing. And if you look at Alibaba, did see rapid deceleration of growth, customer growth into FY16, going into FY17. It did re-accelerate a little bit in FY18. But it's right now at high single digits pretty much. And if you look at where Pinduoduo's buyer growth is, it registered at 35% in 2020, and I think that number will fall to 23%. Again, that kind of number, especially given that now Pinduoduo's user number hit nearly 800 million. That's like 2/3 of the entire population, and well, a little less than 2/3. And so that becomes very, very challenging because how many buyers you're going to have in a family? You're not going to have multiple buyers. So that's going to be challenging. My number is that I have it at around 980 million still, but I have to say that my numbers could be aggressive at this point, and I'm going based on extrapolation. So not only is the buyer numbers growth slowing, but also spending per buyer is also slowing as well. And of course, it's natural, right? If you look at Alibaba, Alibaba did see continued spending per buyer until more recently it's slowed down to mid to low single digits. So I think you are going to see that happen. One good thing I do have to say that one good thing for Pinduoduo is that its buyers are spending only about a quarter of what Alibaba buyers are spending on Alibaba's platform. So there could be more upside, especially as Pinduoduo refocuses on users in not necessarily lower tier cities, but as they target higher tier cities, potentially you could have more spending per buyer. Of course, that also depend on the categories as well. And lastly, path to profitability. I think that's the part that I feel like I'm still in the fog. It remains opaque. I remember with JD, that was a big issue, and because once revenue growth slowed down to more like 50, 60, 50, and then to like 40, then investors will ask, well, what is this profitability look like? Because if the management always promises that if you have enough scale, then you can turn profitable. And just how profitable can you turn? And I think if you frankly, I mean, we shouldn't even be comparing JD with PDD, because Pinduoduo is a pure marketplace platform. JD is a direct sales, but if you look at it, Pinduoduo is still not. I mean, it's generating huge operating losses still, albeit it's largely because Pinduoduo is relying on heavy marketing dollars to generate revenues. And as you can see, that's why the loss ratio is so high, even though in 2020 it did fall from like 28% loss ratio. to 17%. Now that's still a lot. I mean, I think to recover from, especially when you compare to JD. JD is a, you know, JD is a direct seller. You know, they actually buy stuff. They have to put products on their inventory and sell it. Therefore, they have gross margin compression. You know, JD always had only about 14% gross margin, and Pinduoduo has like 70 to 75% gross margin. So I think the marketing is going to be a key challenge for Pinduoduo. And frankly, I mean, it's still a growth stock. So I think investors do focus on top line. But again, if once the top line growth slows, then investors will ask, when does it turn profitable, and how profitable can it be? I think that's going to be a big challenge. And certainly for JD's case, that was the case. In fact, so I think the market focused on JD's margin expansion story from like 2017 onwards. Of course, JD did do well in share-wise after that, because JD did spin off its logistics business, and JD Finance. I think they're still looking to do that, and so forth. So, and lastly, so what is the risk to my bearish stance? I think what could happen that could drive stock up further? I think there are three risks. One is that if there are regulations, more favorable regulations for Pinduoduo that I didn't see related to anti-monopoly law, that could certainly fuel another rally. Secondly, if we do see reduction in marketing expense ratio, and then right now it's at around, as I said, around 60 to 70%. And if you actually see that dropping to more like 40%, 30%, and showing a path towards profitability, I think that will provide positive momentum for the stock. And lastly, if we do see Pinduoduo's annual spending per buyer growth re-accelerating from more like 30% to, let's say, 40, 50, then I think the market will say, hey, they are taking market share away from Alibaba. Therefore, there could be momentum for the stock. So in sum, I think, as I said, I have five major concerns. Basically the most important being the valuation using price to sales, and what happens to stocks when it falls below 100% revenue growth, and as well as when does it turn profitable? I think the company and the stock really needs to give a clear picture to investors when that's going to happen and how that happens. So that's it. Thanks very much. And Michael, we could certainly take some questions.
Thank you very much, Mitchell. This has been very enlightening. As Mitchell said, if you have any questions, feel free to send them in now using the Q&A button. Mitchell, I'll kick things off. Obviously, you laid out a very detailed case here. I guess, how do recent developments with the company, especially regarding the departure of Chairman Colin Huang, factor into your view? Do you expect further impact from that? Obviously, Colin Huang hasn't been the CEO for more than a year, but I guess, does it send some kind of message that impacts your view?
Well, I think it actually supports my view that Pinduoduo is not immune to government risk. And but having said that, I mean, I think they do have very capable people. I think they know the business model is set. They're going after the low cost focused customers. They're also going to target more of the agriculture product delivery and so forth, but it's not going to be easy. I mean, you really need delivery infrastructure. I mean, the two things that you really need if you want to be a successful e-commerce platform, one is finance, and the other is logistics infrastructure, and so that's going to be challenging. Although thus far, Pinduoduo has been doing a good job, but again, I think that taking the founder, CEO, and kind of him voluntarily resigning, so I think that does signal that again, Pinduoduo is not necessarily in the in the favorable light per se. I think this is something that the entire internet platforms are going through in China. So there's no added advantage. I think that's what it really supports. But in terms of leadership, I think that remains to be seen. But I think similar things happen with JD. Similar things happen with Alibaba. I think truly we won't see the effect of the so-called the impact of the departure of these visionary leaders.
Got it. A question from the audience is, what are your thoughts on the investments into group consumer buying? Do you think it will provide renewed growth in top line for Pinduoduo?
Yeah, again, I think, but if you look at Pinduoduo, that's their model, right? That was their foundation initially, group buying, or it's not like Groupon like in the US, where in fact this is much more social media buying. You get your friends and family, relatives, and then you get certain coupons and discounts, and in fact free products, and that's really why Pinduoduo's marketing expenses are very, very high. But why do they do that? They do that because they want to acquire traffic, and they have traffic. So I think in that sense, I think they've been successful at it. They have to, challenge for them is more of translating that into revenues, because as I showed you in my previous chart, and the revenue generated for marketing dollar use is so low. It's only about a tenth or about ninth of Alibaba. So I think that's a big challenge for Pinduoduo. And the group buying, I think Pinduoduo has been doing that the best out of everyone. In fact, Alibaba did try, and I don't think that Alibaba has found success in that. JD is also trying to do group buying, but I think that's been, in fact, I think the head of the group buying also left. So I think that is very challenging to really get people, especially through the group buying pipe. But I think I think that's their Pinduoduo's bread and butter, but I don't see that as anything new per se for Pinduoduo. But that's just one of the things that they'll be highlighting more as one of the ways for them to sustain their growth.
Got it. So the attendee wishes to rephrase their question on that. Pinduoduo mentioned that they will focus on Duoduo grocery, and that there's a substantial amount of investment going into that. So it seems they were thinking about that when they asked whether about providing renewed growth in the top line.
Yeah. Oh, yeah. I think that's a fair question. Yeah, I think that is, if you look at all the e-commerce platform except VIP, JD, if you look at JD and Alibaba, they went into grocery delivery, and that's been a boon for them, especially with the pandemic, right? And that's been that provided incremental revenue for both JD and Alibaba, and Pinduoduo knows that. And Pinduoduo, because its original DNA is in agriculture, I think the company believes that they have an added advantage. I mean, they've actually sponsored all these training programs at different universities, and in fact, they have select people that actually try to teach farmers on agricultural technology. In fact, I think they have like 100,000 people that are actually sending them to rural agriculture areas to really invest in them and then have them share that technology with the farmers. So I think in that front, I do think that Pinduoduo is doing a good job, because they're trying to be more, create more of a kind of pull kind of a relationship where instead of just giving them, like like marketing subsidies and whatnot, I think they're really trying to help them, generate income and thereby becoming a loyal merchant within their platform. So I do think that that's a right step. I don't know how much they are planning to invest, but I do think that if you look at it, it's not going to be profitable. So in fact, we may see losses actually accelerating for the time being for the next few quarters as they invest. Because if you look at, I think Alibaba said too, even after 2 years that they may be barely breaking even on their grocery business.
Got it. Another question from the audience is whether you have a specific valuation estimate range for Pinduoduo's share price, and if so, what multiples did you use?
I think the best multiple to use is price to sales right now, and right now I do think that I would say based on price to sales, I do think that I would give it about $120 range is probably reasonable.
Mm-hmm. Understood. Maybe I'll take this last question from the audience. So is there a premium to Pinduoduo figuring out social buying, especially in rural areas, considering their main users, according to some reports, seem to be female rural shoppers? Is that a playbook that they can take to international markets with similar characteristics?
Yeah, I think everybody says that everybody wants to go to lower tier cities, and everybody meaning all Chinese platforms. They're talking about lower tier and rural cities, but because they are growing slightly faster than urban cities, if you look at consumption, and of course females tend to be like about 70% of the purchases are made by female. So that's something that VIP Shop always touts, that 80% of their customers are female. So, but I'm surprised that they actually keep saying that, because their strength has been in the rural areas, and especially because they first started out as a kind of a selling perishable agriculture and selling it at a deep discount, right? So their DNA is in agriculture. So I do think that that's where their bread and butter is, but I just don't think they have. I don't think they have necessarily much more advantage per se, but but they've been successful. I mean, they could certainly apply like group. Not necessarily, again, group buying per se, because that doesn't really work, but social media, getting more like starting a club, within friends and families and so on. And that could potentially work and then they could allow them to accelerate in terms of gaining market share in the agriculture and grocery business. But I don't know if that's going to be it's going to make a major difference per se.
Absolutely. There's one more question from the audience, and maybe I'll take that one as the last one. So Pinduoduo surpassed Alibaba in terms of annual active users, as you mentioned. So the attendee asks, what do you think are some of the contributing factors to that fact?
Well, I mean, I think the key factor is that they, again, look at their marketing spending. I mean, they are spending a lot. It's like 70% of their sales go to marketing, and in fact, if you looked at a few quarters back, it was 90%. So when you have all these promotions and you're giving out coupons, and if you bring in one more buyer, you get an extra something, and even for merchants, more literally they're not making anything off the merchants per se, right? So although there's some, their transaction revenue is starting to go a little bit better, but again, they're spending a lot to generate their revenue. So if the question is that if they spend normal amount of marketing expenses, can they achieve the revenue growth that they can? And when do they pull back to normal 10 to 15%? And then what does their revenue growth look like? And I think that's, we don't know, but I don't think Pinduoduo is going to be pulling back in terms of marketing spending. So, again, I do think that they're smart. I think they know social media buying probably better than Alibaba and JD. But in terms of whether they have a differentiated way, I don't think so.
Understood. Well, this is a great place to wrap it up. Thank you everyone for attending, and thank you for sharing your questions. If you have any other questions to share, please email us at research@smartkarma.com. Mitchell, of course, has been covering Pinduoduo for a while, and you can find all his insights on Smartkarma. And I do encourage you to go and seek those out. Mitchell, thank you very much for your time today and for everything that you've shared with us.
Okay, thanks a lot. Thank you, everyone.
Goodbye, everyone.